Mark, in your portfolio? I have no clue. I've never researched this company before. Neither has Brian Stoffel. But that's what we're going to do over the next hours together. You're going to see us dig into this company's financial statements, look at its presentations, all in an effort to figure out if we think this company is investable or not. My name is Brian Feroldi. Mr. Stoffel?
I'm sorry about that. I still had the YouTube pulled up and I heard your voice on a 10-second delay. And so I was just a little bit behind. Sorry about that.
You want to introduce yourself?
Yeah, I should introduce myself. My name is Brian, and I have a real problem as a former writing teacher with the fact that Marqeta didn't put a U after their Q. I'm going to try and look past it for this stocks from scratch and give them a clean slate.
I'm also assuming we're pronouncing that correctly, but I literally know. I've never looked at this company at all, but I do know that some people were interested in it. We're doing this because of a vote on our Twitter profile where this number one. So you ready to go, Brian?
I'm ready. I apologize again. I was hearing your voice about 5 seconds slower than it was coming up.
So we're going to start on our investing checklist, and we are going to enter the ticker, which is MQ. So this is a $25 stock, $13 billion.
Nice.
We're going to be filling out the Feroldi quality score, the anti-fragile score, filling out any of this stuff. It's currently down 35%, and best guess
like
is
below
no.
where it probably came public.
Best guess is it's not beating the market, but we'll fill out the rest of it. This video is sponsored by StockCard. Thanks, StockCard, as always, for being such a wonderful partner. So let's start there. So we're on stockcard.io, and we're filling in the ticker, MQ. Let's see what comes up. All right. So if we go all, so it looks like this company came public at 28, or you could first buy it at 28, currently 24. So it's losing to the market there.
You want to take a second? It looks like you might need to re-sign in.
I need to re-sign in.
So while Brian does that, this is a good time to just bring up real quick that next week, we are going to be having our stocks from scratch on Wednesday instead of Thursday. We're going to be having it at noon Eastern. That's 11 o'clock in the good land, the central time zone, because we don't want to have it on Thanksgiving. And the vote for which company we choose will be determined by our members. And if you become a member this month, remember all member dues go to Team C's to take trash out of the ocean.
That's right. Thank you for that. So far, we're up to like $1,500 in donations. So awesome. Go Team C's. Okay, Marqeta, headquartered in Oakland, California, and founded in 2010. Marqeta provides its clients with a card issuing platform. Can you read that?
Yeah.
Okay. That offers infrastructure and tools necessary to offer digital, physical, and tokenized payment options without the need for a traditional bank. We provide a card issuing platform that offers the infrastructure and tools to offer digital, physical, and tokenized payment options without the need for a traditional bank. So I wonder if that means they're going after the unbanked or just simply people that don't want to be involved with it.
Yeah.
The company's open APIs application programming interface, are designed to allow third parties like DoorDash, Klarna, and Square to rapidly deploy and develop innovative card-based products and payment services without the need to develop the underlying technology. So it's a business-to-business company?
Yeah. Definitely a business-to-business company.
The company generates revenue. The company generates revenue primarily through processing and ATM feeds for cards issued on its platform. All right, well, that tells me you have recurring revenue. Okay, so it's growing in the software space. It's growing fast. Sales growth, 102% last year, 56% last quarter, and it's expected to go 72% this year. Okay, not EPS positive. Gross margin is only 45%. These fintechs tend to have lower gross margin. The balance sheet should be good. Free cash flow positive.
Hey,
okay, so not profitable, but free cash flow positive.
Let me ask you a second here real quick. So the way that I'm thinking about, you're familiar with Unity Technologies?
Unity software?
Right, Unity software. They build things for game developers to build their games. and basically they provide an infrastructure for then monetizing them. My first way of trying to conceptualize what Marqeta does is that they do the same thing, except for firms that want to either accept or pay with tokens.
Sure.
Okay.
Fair. Based on what we've seen so far. So it's lost to the market and all this stuff. Okay, so let's go up and check out the company's investor relations website. Hey,
Hey.
our mission is to be the global standard for modern card issuing, empowering builders to bring the most innovative products to the world.
Well, so I can tell them what mistake they made.
Is to be the global standard for modern card issuing, empowering buildings. Is that a complete sentence? Is to be the global standard for modern card issuing, empowering builders to bring the most innovative products to the world. Our mission is to empower builders to bring innovative products to market.
There are times where I wish that we could both write down what we think it should be and then hold them up at the same time, because
Yeah.
what you said is exactly what I think it should be as well. Never do it in comparison to someone else.
Yeah.
And when you say you want to be the global standard, you're comparing yourself to others. Don't do that.
It's a competition-focused company. It's not a customer-focused company. All right, there's a 26-minute video here. No thanks. All right, so we have the latest quarterly results, the 10Q. Marqeta provides developers advanced infrastructure and tools for building highly configurable payment cards. With its open APIs, the Marqeta platform is designed for businesses who want to easily build tailored payment solutions and to create best-in-class experiences and power new modes of money movement. So just based on this, I'm kind of thinking it's Twilio for payments.
Huh. Okay. All right. I like that.
Okay. Teams up with Square. Oh, this is today to power Canadian expansion of the Square card. Well, that's a big vote of confidence.
Yeah, I'll say.
Most recent earnings report. Cool. We'll pull that open. Any presentations to go through?
Doesn't look like it.
Sometimes they hide them in the events. Nope. Governance. So let's go to pull up leadership. Who's on your board? Financials, SEC filings. So do we have a 424B4?
They're doing things back in 2011?
Sometimes there's stuff that happens like years before. Here we go. So we're looking at this. The 424B4, form prospectus for disclosing events. So this is our favorite SEC filing for IPOs because it tells you everything after the company came public. Okay, 45 million shares sold for $27. So good job, bankers. You got this company top dollar.
Yep.
Without leaving tons of money on the table. Okay, so they raised $1 billion, 1.1 billion. Thanks to all these fine bankers. Great. Be the global standard for modern card issuing. Empower builders to bring the most innovative products to the world.
Much better.
Wait, I like that way better. Yeah.
Yep.
$350 million in annualized net revenue. $48 million loss. That was Q4. Okay, Q4. So $350 million in annualized revenue. And this is an $11 billion company?
13.
13? So price to annualized revenue of 30, 35.
Yeah, but it's been 3 quarters since then. And if they're growing over 100%, but look at that. I've never seen that before. I've never seen a company breach 200.
I've never seen a company breach 200% net revenue retention either.
I'm going to tackle just explaining what that is real quick in case anyone doesn't know. What that means is that if you took all the customers from 2019 and compared how much they spent with 2020, they were spending twice as much. And that doesn't factor in any new customers they got, which, Brian, for what it's worth, tells me that there is probably a subscription base, maybe a subscription revenue stream, but also definitely a usage-based one, because you don't see numbers like that without a usage-based aspect to it.
And I wonder if that includes is measure and ability to increase net revenue across existing customer base. Dollar is calculated as net revenue derived during a given period from customers existing at the beginning of the period divided by net revenue from those customers in the same period. This metric reflects any attrition of net revenue lost. Yeah, so
right.
it's a good one. 36 countries, 320 million cards issued. I've never seen the Marqeta sign anywhere, but wow, 60 billion in volumes processed. Okay, the relationship we have with Marqeta is a true partnership, says DoorDash, says Instacart, says Square, says Klarna. Those are some.
Wait, so how is DoorDash using this?
I don't know. We don't know what the business model is yet,
Yeah,
so
I
let's
guess
find
not.
out.
Okay.
Is this too small for you to read?
Nope, I can see that.
Okay. Marqeta created modern card issuing, and we believe modern card issuing is at the heart of today's digital economy. No founder's letter, no here's our mission statement, so just note that. When you order food using DoorDash or groceries from Instacart, modern card issuing works in the background as money moves from the app to the delivery driver's payment.
Yeah, can you zoom out just a
Yeah,
little
one.
bit? There you go.
The delivery driver's payment card, allowing the driver to pay for exactly what you ordered and nothing else. Oh, okay. So in DoorDash's case, because they're spending money on the consumer's behalf, they get the ability to spend the money that the customer already gave them, but nothing more.
Right.
When you buy a big screen TV and pay for it using Affirm or Klarna, modern card issuing helps move money to the payment card that Affirm or Klarna uses to seamlessly pay the merchant.
So in other words, this is a conduit. It lets the exact right amount of money flow from point A to point B.
Yeah, I wonder if they're going to have some customer concentration.
In our comments, they've already said that customer concentration is huge.
All right, well, we'll find that. When you receive money from your friend through Square's Cash App, modern card issuing helps move the funds to your debit card, making it instantly available to you to make purchases. Marqeta's modern card issuing platform, or our platform, empowers our customers, which includes Affirm, DoorDash, Instacart, Klarna, and Square, to create customized payment cards that provide innovative payment experiences for their consumers and end users. I wonder why. I mean, I understand why DoorDash and Instacart wouldn't want to mess with making this in-house, but
yes,
Affirm, Klarna, Square, those are fintechs.
Yeah.
So it's surprising that they wouldn't want to mess with making this in-house.
Well, I mean, the thing is if Marqeta is offering it and they've got the network and they're offering it for a good enough price, then
yeah,
why bother doing it?
Exactly. But I'm just saying that speaks volumes about what they're doing.
That's true.
If these other companies are saying, I'd rather buy from Marqeta than build it myself. Although, we thought the same thing about Twilio, and Twilio has crushed it. But yes. Twilio, Uber was heavily dependent on Twilio, and then Uber said, we're going to take this in-house. We're spending too much on this.
Yep.
So customer concentration. Before the rise of modern card issuing, creating cards was slow, complex, and subject to mistakes. Marqeta solves these problems. Our platform, powered by APIs, enables businesses to develop modern and frictionless payment card experiences for consumer and commercial use cases that are either core of or in support of their core business. The digitization and commercialization of electronic payments is accelerating as commerce is trying to shift online and mobile payments. Yep. Over the last 10 years, the reach of card-based payments expanded as technology eased merchants' acceptance of card payments. In contrast, cards issuing saw relatively little innovation as financial institutions were the primary users of card issuing technology, and their needs largely remained the same. Consequently, those cards had limited functionality.
All right. So as someone who is not involved, like most of this seems like smoke and mirrors to me. Like I don't intuitively understand it. But what it seems like is before, banks would issue cards, and they were not incentivized to do a better job of issuing cards to someone like DoorDash or whoever wants a payment card. They were not incentivized to create better solutions. So Marqeta came in 2010 and was like, you guys aren't innovating. We're going to do it for you. At least that's the narrative they want us to believe.
I would guess it'd be, if you look at the credit card that you have today versus the credit card that existed 30 years ago, they're identical.
Mm-hmm.
And Marqeta has a better way.
All right.
That's my interpretation so far.
Although importantly, I don't think that these are necessarily credit cards. They're more payment cards.
Payment cards.
So
Yes.
there's no credit
But
per
there's
se
the
happening.
issuing. There's the issuing, giving it out.
Right.
That's what they're innovating on.
Right.
As technology-centered organizations with novel business model and needs, such as Uber and Expensify, have gained popularity over the last decade, the inherent constraints of legacy issuing technology needed a new approach. I buy that.
There you go.
Yep. Developers and visionary entrepreneurs desire the tools and infrastructure necessary to build their products to serve customers. They require open, configurable, and well-documented APIs to embed advanced payment technologies natively into their platforms, to programmatically authorize and direct these payment flows without needing to integrate directly with issuing banks and card networks. That sounds like bad news for MasterCard and Visa.
Yeah, it does. Although at the same time, again, well,
open APIs have spurred innovation in previously entrenched industries.
I will say that Joy Division has told us that MasterCard and Visa are early investors in Marqeta.
Good to know. Similar to how Ford is an early investor in Rivian. Take a position in your competition and then buy them later. We built the Marqeta platform to address these needs. Our modern architecture allows for flexibility, a high degree of configurability, and accelerated product development, democratizing access to card issuing technology. Provide instant access to our highly scalable cloud-based and configurable payment infrastructure that enables our customers to launch and manage their own card programs, issue cards to their customers or end users, and authorize and settle payment transactions.
I can see how this would be an enormous time save. Like, you don't have to wait on banks anymore.
Our business is supported by first mover advantage, deep moat of technology, customer, and industry experience. Is the first company to offer a platform for modern card issuing and transaction processing, and we believe also the first market with multiple issuing and process innovations, including the first open APIs, JIT funding. What's that? Don't know. And tokenization as a service. Modern card issuing is secure card issuing and processing delivered via an open API platform that enables card issuers to create customized payment card products that leverage a just-in-time funding feature, authorizing the end user's transactions in real time. So it's blank, and with Marqeta, you can fund it, the payment goes through for just the payment, and then it disappears. That's cool.
That is cool.
That sounds like a security win.
Oh, JIT is just in time. Thank you, Greg Danko.
Integrated with major global and local card networks, modern card issuing enables card issuers to build payment solutions to their specifications and launch them globally. We believe that Marqeta is now the de facto modern card issuing platform, and that our continuous innovation further cements and expands our position.
Well, now I'm wondering how they're only $13 billion.
We believe we are deeply integrated with our customers in 3 ways. AKA switching costs.
Yes.
Our technology underpins their core businesses or support a core business process. Yeah, I would say that payments is a pretty core process. Our people become their trusted partner, and our solutions drive their key processes. In addition, our user-based business model provides both a win-win for our customers
and us. So it is usage-based.
Yes. Thank you. Our usage-based business model. As their business thrives, our revenue grows. The strength and durability of our customer relationships are evidenced by our year-over-year net revenue growth of 103% and our dollar-based net revenue retention rate of over 200%. So awesome, but that sounds like 3% growth.
Okay, see, I was going in the same direction as you, but not even 3% because it says over 200%. So to explain what Brian is saying, basically, it looks like they didn't onboard any new customers.
Yeah, all their growth was from existing customers.
Yep.
Unless the way that they calculate these numbers is funky.
Yeah.
Like, because that can happen sometimes. In the 3 months ending 21st, processed $24 billion in total processing volume, up 167% from $9 billion. Great. Processed $61 billion of total payment volume, up 177%.
Basically tripled.
Full year TPV is less than 1% of the $6.7 trillion in transaction volume conducted across U.S. card issuers in 2020, as estimated by Nielsen, and a fraction of the $30 trillion exchange globally. Our product meet card issuing and transaction processing needs of customers of commerce disruptors and large financial institutions alike. Marqeta has already emerged as a card issuing platform category leader in many disruptive verticals, including on-demand delivery, alternative lending, expense management, disbursement, digital remittances, and digital banks. And our platform is sought out by large institutions to improve their existing offerings and stay competitive. As we expand our use casing, product offering, and global footprint, we attract new industry innovators. It doesn't seem that way in 2020,
No,
and
it
help
did not.
existing customers expand their new verticals, programs, markets, and geographies. Our customers consistently tell us that the ability to work at speed, simplify the complex, and envision their end users' experience, help them focus on what they do best. Blah, blah, blah. Our net revenue doubled. 3 month, our net revenue went up 123%. We incurred net losses of 50. Okay, so
looks like the revenue growth is accelerating, although that's a very easy comp for the Q1.
So their revenue doubled to 290, and their net loss only went down about 10% to 47 million. So that's on a net income basis. Yeah, but that's still their expenses obviously went up tremendously. We incurred a net loss of $13 million per quarter. $13 million quarterly run rate. Trends, digital payments. Yep. Software and payments are converging.
Yep.
The experience economy is driving new developers who need modern platforms. Yeah, I totally buy you have a bazillion trends in your favor. Trust in new payment technology is expanding. 40% of consumers do not plan to resume regular in-store shopping. The rise of globalization, open data, our industry. Okay. Traditional issue processors, FIS, Fiserv, and TYS. So it's not necessarily MasterCard and Visa they're going after. It's Fiserv and FIS. Marqeta. Afterpay was only founded in 2014?
It's kind of insane.
Wow. Because they were bought for like 30 billion? That's crazy. Consumer made up of 440 billion purchases, aided by 24 billion payment cards in circulation. That's 3.5 for every human on the planet.
I believe it. I've got so many that I don't even use.
Since the advent have become the backbone. A complex system underpins because of them issuing banks, acquiring banks, acquirer processor, issuing processor, and the card networks that facilitate the exchange of information. Yeah, it's a complex thing.
Yep.
While the acquiring facing side of the payment system has seen significant innovation, the issuing phase has remained stagnant. There are 300 acquiring banks in the US. However, there are only approximately 200 issuing processors globally. Large financial institutions have historically relied on inflexible and complicated legacy issuers processors. This in turn makes launching new card programs and supporting cutting-edge use cases difficult. Today's card issuer include technology-centric companies that are looking to digitally integrate payment cards into their platform and process growing number of complex transactions. 21st century products, including
I'm gonna ask a question that might make me sound stupid. I don't know what Klarna is.
Klarna? I'm pretty sure they're a payment company. They're kind of like a firm.
Okay.
I'm pretty sure. I remember when we did the deep
buy
dive
now,
on
pay
a
later.
firm. I think so.
Okay.
Marqeta created modern card issuing that enables. Okay, look at this. Modern card issuing, and it runs on MasterCard, Visa, and Discover.
Yep. So Joy, and thank you, Joy. You've added a ton. Says Visa and MasterCard still make money from Marqeta because it still uses their rails for all the transactions.
Gotcha. Thank you. Awesome. Very helpful. Yeah, that's what this graphic clearly shows. So they're the on rails for these processors to collect payments, and they still use the traditional networks.
Mm-hmm.
Modern infrastructure allows for significant innovation in payment ecosystems, enables a new class of card issuers to emerge by simplifying and democratizing the issuing process. It expands the issuing medium beyond physical cards to keep pace with demands of digital commerce and mobile wallets, increasing regulatory and security requirements and cross-border capabilities. It gives developers highly configurable control that enables them to provide a customized solution to their businesses and customer needs. And it operates on extensible cloud infrastructure that works globally and enables scale and simplicity, even as the card issuer, merchant, and customers' demands becoming increasingly complex.
Yeah, I can see how having this be open source is crucial, because once you build a solution tailored to your needs and you can run it on their infrastructure, why would you ever leave?
Yeah, it sounds mind-numbingly complex.
Yeah, like I feel, yeah, this is very complex for my brain.
A modern payment ecosystem puts innovation, accessible flexibility, control, and scale into the hands of the card issuers by delivering all the benefits in one easy-to-use platform. This type of platform solution powers the growth of new verticals and card issuers and enables innovation for large financial institutions who are looking to expand their products and use cases and remain competitive. We believe we've built such a platform. Okay. Our platform and products, finally, provides a single, global, cloud-based, open API platform for modern card issuing and transaction processes. In contrast to legacy infrastructure, the Marqeta platform provides next-generation payment experiences for tech-driven, developer-led companies, as well as and is well positioned to address the payment needs of commerce disruptors, tech giants, and large institutions. Key attributes. We democratize key payment capabilities to enable any business to start issuing physical, virtual, and tokenized payment cards.
I imagine that's a pretty big deal.
Especially the virtual and the tokenized payment cards. Intuitive and rich featured platform is instantly available in our testing environment so developers can build cutting-edge embedding payment capabilities. It's simple. We provide integrations with Visa, MasterCard, Pulse, which is Discover. So everything but American Express. Scalable. It's highly agile and scalable. It's configurable. It's innovative, and it's trusted. It's trusted.
The scalable and the configurable are the most important to me.
Yeah.
Because again, if you can do that, why would you leave?
Well, to me, the most important part is trusted.
Well, yeah, I guess that goes without saying.
Well, yeah. If they were saying all this stuff, but they didn't have Affirm and Square and Cash, like if they didn't have those on board, I would be like, sounds great. Good luck.
Yeah.
Modern global platform helps many of the world's innovators build, run, and optimize their card programs. A product with deep domain expertise and consumer-first mindset. 3 capabilities: Marqeta issuing, Marqeta processing, and Marqeta applications to launch, scale, and manage card payments. Issuing. We enable our customers to issue physical, virtualized, and tokenized cards. With approximately 320 million cards issued to the Marqeta platform across a deep and varied customer base, we have significant industry experience. Our platform can process transactions with control and speed, and customers can leverage applications that cover the entire payment lifecycle, including development tools, program administration, and fraud cases and chargebacks. Help to ensure their programs are as successful as possible. You going to give them credit here for optionality?
I don't know. It's not super strong, but my question is, I wonder if those applications are built in are third party or in-house built. Because if they are third party, I could see how there could be a weak network effect from that part of the business as well.
I'm not following you.
Well, if the Marqeta applications, like let's say those are add-ons. I don't know if they're add-ons or not, but let's just say they're add-ons. The same way that Shopify has a marketplace for applications that you can buy. Shopify benefits from the network effect because they've got 1.7 billion merchants, which means that if I'm a third-party app developer, I'm going to go build my app on Shopify first.
Yes.
So I'm wondering if Marqeta has the same thing there. It doesn't make it clear if these are in-house apps. Are all the apps available if you use the product, or
I'm assuming yes. I'm assuming they're all in-house and there's no third party because they haven't called that out.
Right.
So I would assume no to the network effect.
Right. If that's the case, I agree.
Our modern cloud-based open API delivers card transaction processing. Yep. 57 million active cards, 1.6 billion transactions. We employ a usage-based model based on processing volume that aligns our interests with our customers. Agreed. We derive the majority of revenue from interchange fees generated by card transactions through our platform. In addition, we also generate revenue from other processing services, including monthly platform access.
Oh,
So that's like subscription,
Yeah, that's a subscription. It
ATM
sounds like it's
fees,
pretty
and
small, but
tokenization services. Our platform enables new and existing customers to create innovative and configurable card issuing programs and to increase their processing volumes. Additionally, we expand our use cases so that we help our customers expand into new verticals, experience success with the strategy, into new verticals, programs, markets, and geographies. So once you're in, Marqeta makes it easy for you to enter new spots, which is why their revenue retention rate was over 200%. That is just a crazy number.
it is a
Crazy number. Modern card issuing trailblazer, our strengths. First mover, and we're doing it better. Widening the gap via continuous innovation. So we're always rolling out as we partner with our acceptance to support their ambitious global projects. We also attract new customers seeking best-in-class solutions.
This is what I want to find out more about because it doesn't look like that.
Yeah. Okay. Well, we enable innovation that introduces opportunities for further innovation by customers, creating a strong network effect that further cements and expands our market-leading position. You're going to have to defend that because I'm not. The highly configurable platform is agile out of the box and at scale. Our developer-centric API sandboxes into software development kits or SDKs written in language help our customers go to market with unmatched speed. We offer that same flexibility and extensibility when customers' programs are live and in markets so they can expand into new geographies. These new characteristics make our platform valuable to existing customers and attract new. So they're saying they get the network effect because their product gets better and that it makes it more attractive. No, that's not the network effect.
I mean, it could be.
I'm
When
giving
we talk
them a
about
0.
AI, it could be, but that's not super strong to me.
It doesn't make the product exponentially better, or there's no benefit for you to join the network. I mean, the product gets better. I'm not buying that. Enduring relationships. This I buy. Very, very high.
Yeah, but do you see over 200 in 2019 and 2020?
Wow.
So that means that whoever was with them. Now, here's what I'm going to say, Brian. Based on a bunch of the comments on the side, Square is like 70% of their revenue.
Holy cow.
Now, I'm not sure if that's still the case, but if that is, I can see how they can have that level of net revenue retention because almost all of it's coming from Square. So what they're saying is they've 4x'd the number of the total payment volume probably via Square in the last 2 years.
And if Square then has negotiated lower, better pricing with volume increases, that would be a difference between.
Oh, I didn't even think of that.
That would be a difference between the revenue growth and the DBNR, if that's the case, and we should see that in the gross margin.
Yep.
If that's correct. Clarity of our mission, and the clarity of our mission. I think your mission statement needs work. Okay, market opportunity.
Big, huge.
Infinity. It's huge. Yeah, growth strategy. Grow, onboard, broaden, develop, expand, invest in people, culture, and values. Our mission is to be the global standard for modern card issuance, empowering builders to bring the most innovative products to the world.
At least it's the same.
Yes, it is the same. Our culture is built on the foundation. Build one Marqeta. Cares, belongs, lead, deliver. Quality first. Okay. We made it through. All right. So
they didn't sell that much.
Well, look at it. Everything was Class B stock before this. They created a new class of stock to bring to the public. So it's not like I'm guessing Class B has 10x voting. So yeah. 10 votes.
There it is.
So there you go. So this is a 99% voting power. So they sold 10% of the company and gave away 0.9% voting. Okay. Our executive offers will own 32% of the stock. Wow. I don't know if I've ever seen it that high between the two. All right. Gross margin. Gross margin actually went up. So much for that theory.
Well, in a way, it kind of would have to, because for that net dollar retention isn't based on total payment volume. It's based on revenue.
Yeah. So, but that's still, they must not have landed it. I don't know. I'm still confused there on the customer.
I agree that it looks like they haven't landed anyone. But again, well, here's the thing. If Square is that big of a customer, they could have landed, you'd need to land like 20 medium-sized customers to move the needle on overall revenue.
Sure. Still, how many of those Square-like customers are out there for them to grab?
Not many. I don't think.
All right. So the way they don't break out, this is weird.
This is very weird.
I've never seen
this before.
I've never seen this before. Compensation and benefits, stock-based comp of in the 28 million for the years ending, 3 months ending. Okay, so 11.4 million in here is stock-based comp. Yeah. So how much are you spending on sales and marketing?
Don't know.
I don't know. It's in there somewhere.
It's in both, kind of.
60 million. I'm gonna go out in a hunch and say half. That's
hard to say.
Fairly typical. But actually, if they have a relatively small number of customer bases, it might be a very small percentage.
It might be. It depends. I mean, they want to get away from Square.
Maybe they break that out elsewhere. But okay, $12.8 million quarterly net loss, $11.4 million in stock-based comp. So they're basically cash break even. Balance sheet, $1.3 million in cash, $187 million in total liabilities, no debt. All the convertible equity is gone. This balance sheet is awesome. Total processing volume up. Net loss is minimal.
Look at what happened in that first quarter. That's crazy.
What?
Just going from 9 billion in total payments to 24 in the first 3 months, 2020 to 2021 in TPV.
Oh, okay. You were rounding up. I was like, where's this 9?
Yeah. That's just crazy.
And their adjusted EBITDA is now positive. I hate that metric, but it is positive. Okay. Card issuing. A card issuer is a business that issues customized card products to its user. Interchange fees are charged to the network. These are actually helpful. JIT is just-in-time funding. Revenue share. Okay, risks. Rapid growth.
Goodness. Just everything.
So let's do concentration. Concentration of ownership. Okay. As we expand, we attract new industries. Our customers can. Yeah. For the year, we generated 60% and 70% of revenue from one customer, Square. And that number went up.
It's going up. Well, at least when they went public, I think we should have at least one more quarter. But so that their dependence on Square is going this way.
Revenue, interchange fees, processing and other fees, total services, other services, 119. Oh, no. That's the change. So total platform revenue is 106, but their other services
it's not much.
Is not much. 1%. So it's an interchange and processing business. It's not a. I'm guessing this is where the subscription fees lie.
Yeah, probably. So they're taking about a 4-cent cut of it, or no, maybe even less than that. 0.4 of a cent cut.
Based on their processing volume?
Yeah, based on their total processing volume.
4 cents of every dollar?
No, less than 4 cents.
Because that would be high.
Yeah, it would be high.
4%.
It's basically half a cent.
Yeah, that I would buy. I would assume they're taking 2.5 or 1 or something, and then they're giving half to Visa and MasterCard.
So because it's 108 million divided by 24 billion. Yeah.
Okay. Yeah. Small.
Yep. Half a penny.
Half a penny. Okay. Okay. So where did it go from Square? 168% increase in volume from Square and 165 from everybody else.
Well, at least it tells you that the
fees.
others are growing just as fast.
Yeah, they're all growing very quickly. Cost of revenue, card network fees, that's the largest one. Issuing bank fees, other, gross profit, gross margin, 46%. So it's increasing. Card network fees. Okay. Here we go. Share-based. Yeah. So nothing in here about
Sales.
yeah. Professional services expenses. Yeah, I thought that was going to be revenue for a second. Technology, occupancy. There we go. Marketing.
Hey, look at that.
495,000.
That's in thousands? Oh my
Thousands.
goodness. Well, that's insane.
That it makes sense though if they have such a
Yeah.
concentrated customer base.
Yep.
It's like we saw with Olo. When I researched Olo, their sales and marketing budget as percent of gross margin was like 5%, but it was because it's a super concentrated sale.
You're on this is the flip side of concentration.
Yes.
So it's by quarter.
Marketing and advertising. Yeah. I know that sales isn't in there, right? So it's just purely marketing and advertising. So sales is in there too. And you could also argue that professional services is also sales.
Yeah.
But overall, I'm going to give this company a lot of credit for very small spending on customer acquisition. On the flip side, holy customer concentration. Okay. Was there anything else here you wanted to check?
Do they give a customer count?
Not that I saw.
I didn't. You know what? That would have been under the management's discussion if it was in there.
It does say a significant portion of the company's payment transaction are settled through one issuing bank, Sutton Bank. 94% of issuance was settled by Sutton Bank. So there's a enormous concentration on that side of the ledger too. Okay. Customer A was 73% of sales. Customer B, there was no other customer.
Those are receivables.
One customer owns 13% of accounts receivables, but yeah. I wonder if the Square is going to just buy this company. All right, that's it.
That's it.
Okay.
Well, let's see what the most recent quarter told us.
Up 56%. Revenue was up big. Gross profit margin up 67%. So margin expansion, 45%. Jason Gardner, founder and CEO. So as a founder, a significant new customer, Bill.com.
Hey, look at that.
Will leverage the switches for its streamline their payment processing to power Figure, which has built-in buy now, pay later. The new category of card issuance with Coinbase, Fold, ShakePay, and Bakkt. The launch of a new card program, Uber Freight, which gets earnings paid faster.
I could see how that would
European
be
business
very helpful.
Is growing 340%.
Off of what base, though?
Probably a small one still. Yeah. That's product market fit.
Yeah.
M1 Finance.
Huh. And
MasterCard's installment payment. Okay. So gross margin was up. Net loss was huge. I'm guessing a whole bunch of that is stock-based comp.
Yeah, so they don't tell us how many customers they have. Okay.
Yeah. Maybe that's in the conference call. Yeah, still here. Very small on that. The balance sheet looks awesome.
Can we just wait, can you were just on it for 1 sec. Can you just I want to see the cash flow statement in the most recent quarter.
Oh, okay. Was it here?
I think it's up. Yeah, there we go.
Oh, I'm sorry.
So
9-month ending.
So why do they have such a big
so sources accrued expenses was 34 million. So expenses are going up. So this was actually cash flow from operations positive,
but just barely.
So free cash flow is just barely negative, and the year before it was positive.
Yeah. So the big difference it looks like is in network incentives receivable. Oh, and a huge one from revenue share payable. That just means they paid them out. Okay.
So there might be some. So they're teetering close to the line of free cash flow.
Yeah. And what does their updated balance sheet look like too? Actually, now that we're on
it said like 1.2 billion in cash and total liabilities 200 million. So no
really
long-term debt.
Okay.
Yeah, really great there. Oh, people like this company. 106 ratings, late stage. Did we get a share issuance? Did we get a ownership?
Yeah. We didn't. We didn't look that up.
Did we miss that?
Beneficial always gets me there the fastest. The word beneficial. There we go.
Okay. Never heard of any of these, but CEO owns 14%.
All right.
Or Christopher McKay. Who is he? He must be I'm guessing a board director.
That's what I would guess.
McKay. Granite Ventures. Yep. So that's one of their early investors. So insiders.
Either way, 14 is pretty high.
Right. Times $1 billion, 13. So $1.5 billion.
Mm-hmm.
Let's go to the management team. Okay. I'm
just curious, what is the founder's background? Like,
mission to become the global standard for modernization. Well, they got his mission statement in his, there you go. Entrepreneur of the Year by San Francisco Business Times. He founded Property Bridge was acquired by MoneyGram. He founded, okay, so he's got,
this is his third,
yeah.
This is his third rodeo.
Yeah.
And he sold tie-dye t-shirts. Is
that what it says?
In New Jersey, yes.
So he's an entrepreneur. Cool. Chief Revenue Officer. Amazon Web Services. Okay, that's a pretty big one.
Never heard of him.
It's on a mission to power the world's innovators.
I mean, that's close.
Yeah.
You're close.
Yes. Our board.
Any names you recognize? Because none for me. It looks like it's a whole bunch of the early investors.
Nope. I mean, nope. Crypto cards, insurance. Okay. You ready?
Yeah.
All right. Marqeta, today's date, 11/18/2021. Financial resilience, awesome, 5 out of 5. Mm-hmm. Gross margin, it's below 50%, but it's rising fast, 1. Returns on capital, 0. Free cash flow, 0. Earnings per share, 0. These numbers could change in a hurry. Moat, product ecosystem or network effect, no. Switching costs, migraine level pain. Yep. I got 13.
Ooh, I've never seen you give over 10 for something. Individually.
A DBNR that high?
Oh, I'm not disagreeing with you. I'm just pointing that out to our viewers.
Durable cost advantage, no. Intangibles brand, nope. Counter positioning.
Versus those legacy players?
I don't know how they charge.
I imagine it's not an open system.
Do you think that they would have to change their business model to compete? I would imagine it's also on a percentage of
total payment volume.
I'm going to assume no, but I could be wrong there. Mm-hmm. Moat direction, getting wider. Optionality.
This is a tough one. Yeah.
I'll go 4. That's 3 or 4. 4 is probably too generous. 3 is too stingy. I'll go middle of the road. Growth, organic revenue growth, 4 out of 4. Are they a first mover? Top dog and first mover? No, but they're a disruptor.
Yeah.
I assume they're a disruptor. Operating leverage ahead, tons. Customer acquisition, I'm going to go 5 out of 5.
Yeah.
Customer dependence.
I mean, total payment
very high
would fall a little bit in a recession. But the customers aren't going anywhere.
Actually, what happened to the company's revenue? Didn't we have that?
The thing is this
spending would go down broadly in a recession. So the company's revenue would ebb and flow with that once it reaches critical scale.
Right.
Now that's not a problem. Eventually it would
because it's growing so fast that even
taking so much share.
Yep.
Is revenue recurring? Yup. All of it's recurring. Does it have pricing power? Gross margin is on the rise.
Yeah, and I think it has pricing power based on those switching costs.
So it does have switching costs, but however, 75% of this company's sales are from one customer. Does it have pricing power over them?
Probably not.
So for that reason, I'll go 3. Soul in the game, 4. Inside ownership, 3. Glassdoor ratings, 4. Mission statement, it's consistent. It's not, I'll go 1. The stock has lost to the market. They're not doing anything with their cash. Are they doing versus expectations? MQ stock. Beat? No. Never mind. Huge beat. 2 for 2.
All right.
That's a 70. And I might even be too stingy here. I'll go 4 on this one. Yeah, okay, I feel good about that. The bad stuff, accounting irregularities. Nope. Customer concentration. Yeah. Like extreme, -5. You might even argue that should be a -7.
Yeah.
Industry disruption. Nope. Outside forces. No. Big market
Not at
loser.
this
No.
point.
Binary
If they're
event,
at
no.
scale, maybe.
Dilution. What was the dilution rate? Stock-based comp for the quarter.
I don't remember.
Stock-based. What did they call it? Where's the cash flow statement?
Down there it is.
Share-based. 105 million for the 9-month period, and 9-month sales were 361.
Ooh.
100 million divided by 3. That's 30%. That's pretty high.
Yep.
Stock-based comp is high. I'll just do 2. Growth by acquisition. Nope. Complicated. Headquarters. Currency. Nope. Total score is 64. Yet another company I don't want to put on my don't buy it list. I don't want to bet against this company, but it's just like it's the stage that it's at right now. It's just very high risk.
And Brian, we're not modeling our frameworks as the panacea, the one size fits all. We're trying to model holding ourselves accountable and evolving over time.
Yeah.
So if you're noticing that this is happening, then come 2022, when we both take a look at our frameworks and what we might want to change, then in real time, people can see it's okay to change, which I think is the best value we can offer people that are watching on YouTube.
Yes. It reminds me of Upstart. Said with Upstart, we're like, there's lots to like here. Upstart, I liked probably even more, but Upstart had major concentration issues. Those are coming down substantially, but Upstart went into my past portfolio, and it was been a tremendous winner. I could very much see Marqeta walking in those same footsteps.
Yep.
Okay. Anyway, your turn.
Mission statement. I give them 1.
That's more than I thought you were going to give them. Okay.
I mean, I think to empower builders to bring the most innovative products, that's inspirational, and I could see how that's optionable, but it's just not simple. So for this, I'm going to just give them 2 points because the switching costs is all that I see. I could be wrong, like you said, on the counter positioning, but I'm not sure. I'm going to give them 2 points for optionality. The one thing I will say is that I think
also more generous than I thought you were going to go.
Well, the thing is that when I look at it, I think that some of the applications for their technology show a lot of optionality. So like Intuitive Surgical, for instance, like I've given them high scores for optionality for a long time, even when the Da Vinci was all they had. And they didn't have the Ion and all these other things that they have now, but that's because the applications for the Da Vinci in different surgical procedures were so vast. So while I might not necessarily see them coming out with brand new products all the time, I can see how they can say, yeah, we're with Square now, but look we can use it in all these other ways.
The application of the technology has optionality,
right.
not the okay.
NVIDIA is another great example.
Yes.
Like, you know,
We make
cryptocurrencies
processors, but
fall
look at all
off.
these potential uses for
Right,
them.
exactly. Like, you know, tell someone about cryptocurrencies 10 years ago in NVIDIA and they look at you like you're crazy. Like, what's that?
Yep.
I give them a half point here just because they're not super free cash flow positive. Once they are, that
They're
will
negative.
change.
So, okay.
Yeah, but like they're right
They're so close.
there.
Yeah.
Concentration -3. I've got to take all 3 points off. And then I give them a point on each one of these. So this time, unlike where Upstart got to be on my positive side, I'm going to join you. And if we're wrong about Marqeta, we will feel the pain together.
Yep. So both of us, I would say, I'm not betting against this company ever.
No.
But it's just too risky right now. So for that reason, it's going to go in my anti-portfolio right now. So this is an MQ. We're going to go to stock card. We're going to say buy. Remember, we're buying it in the anti-portfolio. The current date is the 18th. The current price is 24. So that's 40 shares.
40 shares.
And this was a score of 66? 64. Oh, by the way, if this company became profitable, these would flip to 7 to 6, and the company would be investable. So it is darn close. It is darn close to that right now.
And for me, if it didn't have the concentration risk, it would go from a 5.5 to an 8.5. And what was the other one that I? Oh, and if they're free cash flow positive, that's up to a 9. So look, we've been burned before by over focusing on concentration risk. If you're watching this at home and you think, I don't care, then account for that with your position size. I've already seen Joy and someone else in here talking about how that was the case with Upstart, and it's totally true. And I think it's worth pointing out that my framework, at least, is designed so that anything that gets a 12 or above is almost guaranteed to be a great holding. And that's always been the case for the 5 years I've been doing this. There are tons of stocks that get lower scores like this that go on to be great holdings, but there's also tons of ones that get lower scores that don't. And so to make my life easier, I just focus on the ones that are with a 12. But that works for me, and it's not one size fits all. Yep. And Joy's right. Once they are diversified, if they get there, it will be 10x. It'll be a $100 billion company. I think Joy is absolutely right.
Yeah, and they're clearly signing up new customers too. And again, they've gotten some heavy hitters on board. Mick Bach Anon says very, very, very similar vein as Upstart.
Yeah, I completely agree.
Yeah. Yeah. So the customer concentration here is, and this is why we talk about this, right? It's like, could this work out? Absolutely. But what happens if Jack Dorsey wakes up one day and says, I want to do this ourselves?
Right. And
bye 70% of revenue.
And that's where, and we don't, we talk about this when we're discussing things, but we don't have any way to account for this in our sheets. But that's where position sizing comes into play. So if you just have a 1% position, then if Jack wakes up and it's like, you know what, we're doing this, then you lose a little bit. It's not a big deal. But if you just have that 1% and it becomes huge, then good for you.
You can totally, you can totally take that customer concentration risk off the table by positioning it correctly. And this is a $13 billion company. For a sense of scale, Square is a $100 billion company. Upstart is a that's down to 18 billion. Upstart is an $18 billion company. So yeah, so just keep those numbers in mind. This stock could 10x if it continues to execute, and their dollar-based net revenue retention rate is one of the most impressive numbers I've ever seen.
Yes.
So I hate having this in my anti-portfolio because the upside here could be so big. But to your point, perhaps We'll learn a lesson here.
Yeah.
Either way, thank you all so much for watching. Thank you to Joy Division in particular for the wonderful comments. Dave Drum, as always, for the wonderful comments, and everybody that was watching here. As a reminder, if you become a channel member through the month of November, 100% of that revenue is going to Team C's to take trash out of the ocean. So we hope that you consider that. Thanks so much for watching. Brian's out.